Hello everyone. Welcome back to Educator Guru YouTube channel. Today we'll be going through important accounting ratios of accountancy subject for second PUC students. Before starting, I would like to request everyone to subscribe to our YouTube channel and also share among your friends who are in need. Thank you. Now let us move on. Now, before understanding what is accounting ratio, first we'll understand the concept of ratio. A ratio is a mathematical number calculated as reference to relationship of two or more numbers and can be expressed as a fraction, percentage, proportion, and number of times. In simple words, in our daily life, we use ratios. For example, while cooking a rice, you take one measure of rice and two measures of water. So here the ratio is 1:2. And when you score marks in your school or college, whatever, in your exams, you get some total of the subjects, out of which you will calculate the percentage, which is also called as ratio. So in our daily routine life, we use ratios everywhere, but we would have not observed that in detail. Now let us understand what is accounting ratio. When the number is calculated by referring to two accounting numbers derived from the accounting statements, it is termed as accounting ratio. Now, let us take an example to understand the meaning of accounting ratio. For example, the gross profit of the business is 15,000 and the revenue which you have, that is the income which you have earned in that particular year for the business, is 1,15,000. So we need to calculate the gross profit ratio. How will you calculate that? It is simple. Like, first we have to take the profit divided by the sales amount, whatever income you have got, total revenue from the business. So here it is 15,000 divided by 1,50,000. So to convert that into a percentage, you'll have to multiply it by 100. So the answer is 10%, which is called as gross profit ratio of the business. Next, there are different types of ratios. There is traditional classification and functional classification. Under traditional classification, we have statement of profit and loss ratios, balance sheet ratios, composite ratios. Whereas under functional classification, we have liquidity ratios, solvency ratios, activity ratios, and profitability ratios. So, for our syllabus, we have functional classification. So now let us concentrate on functional ratios, which are liquidity, solvency, activity, and profitability ratio. Liquidity ratio is a ratio where you can consider the things which are, items or assets which are easily convertible into cash. For example, we will have many types of assets like buildings, land, furniture. Those cannot be converted into cash very quickly or in a fast manner. So here liquid is nothing but easily convertible into cash in a very quick way, like cash in hand, cash at bank, demand draft, like that. So under this ratio, we'll consider only current assets and current liabilities. Next, coming to solvency ratio. Solvency ratio is a ratio where it is calculated to find out the ability of the business to repay any loans or debts. So in that case, we'll apply solvency ratio. Then activity ratio. It is nothing but a thing where we need to find out the performance of the business, to know how the business is being performed very well or moderate. To know that, we'll use activity ratio. Then profitability ratio is nothing but a ratio which is calculated to know the earning capacity of the business, how much profit it has earned, whether profit or loss. So to find out that, we use profitability ratios. Now we'll see the formulas of all these ratios one by one. Under liquidity ratios, we have current ratio and quick ratio. Under solvency ratio, we have debt equity ratio, debt to capital employed ratio, proprietary ratio, interest coverage ratio. Under activity ratios, we have inventory turnover ratio, trade receivables turnover ratio, trade payable turnover ratio, net assets turnover ratio, fixed assets turnover ratio, working capital turnover ratio. Then under profitability ratios, we have gross profit ratio, operating profit ratio, net profit ratio, return on capital employed, return on shareholders' funds, earnings per share, book value per share, dividend payout ratio, and price earning ratio. Now, first one is current ratio. The formula says current assets divided by current liabilities gives us the current ratio. But what is to be considered under current assets and current liabilities, that we need to understand. If you get that clear, then it is very easy for you to calculate current ratio. So current assets includes current investments like short-term investments, inventories, which is nothing but stock in trade, trade receivables like bills receivable and debtors, cash and cash equivalents, which is nothing but cash in hand and at bank, short-term loans and advances, that is short-term loans to employees, advance tax paid and prepaid expenses. Other current assets also like outstanding or accrued income needs to be considered under current assets. So in short, current assets consists of cash, bank, trade receivables, accrued income, short-term investments, inventory, advance tax, prepaid expenses. Next, current liabilities. This includes short-term borrowings, that is bank overdraft, short-term loans from the bank, trade payables like creditors, bills payable, other current liabilities, which is nothing but outstanding salary and unpaid dividend. Also, we have short borrowings, that is proposed dividend and provision for taxation. So, in short, current liabilities consist of trade payables, bank overdraft, outstanding expenses, income received in advance, proposed dividend, and provision for taxation. Next, coming to quick ratio, which is also called as liquid ratio or acid test ratio. So any name they ask, it is the quick ratio. It has three different names. The formula goes like quick assets or liquid assets divided by current liabilities. So what is quick assets? What does it include? That we will see now. So quick assets is nothing but current assets minus inventories, that is stock, minus prepaid expenses, minus advance tax. So in simple, we can say quick assets consists of only cash in hand, cash at bank, trade receivables, accrued income, and short-term investments. That is all. Hope that is clear to you all. In current assets, we have inventories, prepaid expense, advance tax paid, which is used for calculating current ratio. Whereas in quick assets, we'll have to remove the inventories, prepaid expenses, advance tax paid. Then you'll get the quick assets. Next, debt equity ratio. Debt equity ratio formula says long-term debts divided by shareholders fund. So what does long-term debts and shareholders fund include? That we will see. So long-term debts is nothing but debentures and long-term borrowings. Shareholders fund consists of equity share capital, preference share capital, reserves and surplus, consisting of both reserve fund and statement of profit and loss, that is the profit and loss account balance, and any other reserves if any. Or in simple words, you can say shareholders funds is nothing but non-current assets plus working capital minus non-current liabilities. But when you use this second formula, you'll have to also calculate working capital, which is current assets minus current liabilities. That this you need to keep in mind. Next, debt to capital employed ratio, which is also called as net assets ratio or investments ratio. So long-term debt divided by capital employed, or long-term debt divided by net assets also you can take. So we'll see what all is included in long-term debt and capital employed, so that it will be easy for you to calculate the ratio, that is debt to capital employed ratio. The name itself says debt to capital employed. So debt divided by capital employed. It is very easy to remember. So capital employed is nothing but shareholders' funds and long-term debt. Whereas net assets consists of fixed assets without depreciation and fictitious assets like preliminary expenses not written off, discount on issue of debentures not written off, underwriting commission to be written off. So these all need to be removed from the net assets. If it is included, then also depreciation you have to deduct and you have to add the working capital, which is current assets minus current liabilities. So fixed assets minus depreciation minus fictitious assets plus working capital is known as net assets. Next, proprietary ratio. Proprietary ratio is shareholders fund divided by capital employed or divided by net assets. Next, interest coverage ratio. Interest coverage ratio formula says net profit before interest and tax divided by interest on long-term debts. So, interest on long-term debts consists of interest on debentures, interest on other long-term loans. Here, net profit, if the net profit is inclusive of interest and tax, then you have to take out that. Before, you have to add back. So, before deducting interest and tax, what is the net profit you have got? That you have to consider for interest coverage ratio. Next, inventory turnover ratio. The formula says cost of revenue from operations divided by average inventory. The inventory turnover ratio is also called as stock turnover ratio. So now we'll see what is cost of revenue from operations and average inventory. So cost of revenue from operations is nothing but revenue from the operations. That is the income which you have earned from the business minus gross profit. So without gross profit, you have to consider, which is called as the cost of revenue from operations. Then revenue from operations, how we will get, that is nothing but sales, which is inclusive of both cash and credit sales, but you have to deduct returns and excise duty if any. Then only you have to calculate the sales. So if cash sales and credit sales are there, then you'll have to deduct any returns, that is sales returns, and any excise duty on that you'll have to remove, and then you'll get the revenue from operations. Then cost of revenue from operations, what does it include? That is cost of goods sold. In simple word short form, we'll say COGS. So this consists of opening inventory, that is opening stock, plus net purchase, plus direct expenses like wages and carriage inwards if any, then minus closing stock or closing inventory. This is cost of revenue from operations or COGS. Next, average inventory. The formula says average inventory. So average is nothing but a mean. So the middle value, that how we will calculate. So we will calculate opening inventory plus closing inventory divided by 2, or opening stock plus closing stock divided by 2. So in this case, if in the problem they have given only opening inventory or closing inventory, any one has been given, then that alone has to be considered as average inventory. So no need to get tensed or confused at the exam. Any one has given, then you just write a note saying only either opening stock or closing stock has been given, and that has been considered as average inventory. Next, trade receivables turnover ratio. The formula says net credit revenue from operations divided by average trade receivables. So now we'll see what is net credit in revenue from operations. So that is nothing but credit sales. When does the trade receivables come? When you have not paid cash, when you have not received cash for your sales, you have sold it on credit. So that is when the concept of trade receivables arise. So for calculating that ratio, you'll obviously consider only credit sales and not cash sales. If in question, for example, they ask this formula to ratio to calculate, and the revenue from operations does not give details about cash sales or credit sales, nothing they give, they just give revenue from operations, then you consider that as net credit revenue from operations by giving a note in the examination. Next, average trade receivables is nothing but opening trade receivables plus closing trade receivables divided by 2. Or you can, if both trade receivables and debtors are there, then in that case you have to add both opening debtors bills receivable plus closing debtors and bills receivable divided by 2, where you get average trade receivables. Similarly, in this case also, only opening trade receivables or only closing trade receivables are given in the question, then you consider that alone as average trade receivables. And also it should be noted in your mind that debtors should be considered before making any provision for doubtful debts. So the debtor should not include any provisions for doubtful debts while calculating this ratio. Hope that is clear to you, everyone. Next, trade payable turnover ratio. So here it is net credit purchase divided by average trade payables. So net purchase is nothing but purchases divided minus returns. Then also in the question, same like sales, if they have not given credit or cash purchases separately, then you consider whatever purchase amount they have given as credit purchase and calculate the trade payable turnover ratio. Next, average trade payables, similar to trade receivables, opening and closing you add divided by 2, or if you have both bills payable and creditors, then you'll have to add both opening of credit bills payable and creditors, then closing creditors bills payable divided by 2. In this case also, if only opening or closing trade payables are given in the question, then consider that alone as average creditors. Next, net assets or investment or capital employed turnover ratio. So the formula goes like this: revenue from operations divided by capital employed, or revenue from operations divided by net assets. Next, fixed assets turnover ratio. So the formula is net revenue from operations, that whatever the net income you have from the business, divided by the net fixed assets. So here we have to first make a note that both revenue from operations and net revenue from operations are same while calculating any accounting ratio. So that you need to keep in mind. And here the sales, whatever the net revenue is there, no, that how you need to calculate that, you have to first deduct returns and excess duty from sales. That is the net revenue from operations. Next, working capital turnover ratio. It is net revenue from operations divided by working capital. In the previous slide, we have seen net revenue from operations formula. Working capital formula is nothing but current assets minus current liabilities. In my previous slides, I have also explained what all current assets include and current liabilities includes. Kindly keep that in mind and calculate the working capital. And then you'll get working capital turnover ratio. Next, gross profit ratio. Gross profit ratio is nothing but a trading account profit, whatever you get, that is called gross profit. So that ratio you need to calculate. The formula for that is gross profit divided by net revenue from operations. So gross profit is nothing but revenue from operations minus cost of revenue from operations. Income minus expenses. Next, operating ratio. Operating ratio is equal to operating cost divided by net revenue from operations into 100. If you multiply it by 100, then it will become a percentage, or else it is simple ratio. Operating cost. So operating cost consists of cost of revenue from operations and other operating expenses. So what all things are added in cost of revenue from operations? It is very simple. Purchases, then opening inventory, then direct expenses like wages and carriage inwards, and you have to deduct the closing inventory. This is the cost of revenue from operations. And here, the main thing is the purchase consists of both cash and credit purchases. You have to consider both the purchases and deduct the returns or excise duty, if any, are there in the question. Next, net revenue from operations. It is nothing but cash revenue from the operations, that is sales, and also credit revenue from the operations, that is credit sales, by deducting the sales return. So in simple words, total sales, that is both cash and credit sales, minus sales return, we will get net revenue from operation. Then operating expenses consist of administration expenses and selling expenses. Next, operating profit ratio. So operating profit ratio is very simple. In 100, if you remove the operating ratio, 100 minus operating ratio, you'll get operating profit ratio. Or you can also calculate it this way, like operating profit divided by revenue from operations into 100. So what is operating profit? It is nothing but revenue from operations minus the operating cost. So here operating cost consists of cost of revenue from operations and other operating expenses. Next, net profit ratio. Net profit comes in the profit and loss account. So that ratio formula says net profit divided by revenue from operations into 100. So you'll get the percentage. So here net profit is to be considered only the profit after tax. After considering the tax, after deducting the tax, whatever the profit you get, that is called as net profit. Next, return on capital employed or investment. The formula says profit before interest and tax divided by capital employed into 100. Here, if the interest on debentures or other long-term loan and income tax are already deducted from the profit, then these two items should be added back to the profit, because they say profit to be considered before deducting interest and tax. So that you'll have to keep in mind while calculating the return on capital employed ratio. Next, return on shareholders' funds. It is also known as return on net worth, RONW. It is profit after tax divided by shareholders' fund into 100. Next, earnings per share. In simple short form, we say EPS. It is profit available for equity shareholders divided by number of equity shares. So equity shareholders fund, first that you need to understand what does it consist of. So shareholders fund minus any preference share capital that you'll have to remove. In simple words, equity share capital plus reserves and surplus inclusive of all the reserve fund and statement of profit and loss balance is equity shareholders fund. Next, dividend payout ratio. It is dividend per share divided by earnings per share. So how will you calculate dividend per share? That is amount of dividend, the total amount of dividend what you have, that needs to be divided by the number of equity shares you have in the business. Next, price earning ratio, which is nothing but PE ratio. Market price of a share divided by earnings per share. In the previous slide, you have seen the earnings per share formula, that whatever you get EPS, that you have to consider here. So market price of a share divided by earnings per share, you will get PE ratio, which is nothing but price earning ratio. Hope you were all clear with the accounting ratios formulas and how to calculate what all needs to be included in each and every item while calculating individual ratios. Hope it was very helpful. If you like this video, please like, share, and subscribe to our YouTube channel. And all the best for your exams. Thank you.